Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What is your outlook? Again, do you have a directional bias? Do you believe that there's going to be a significant move in one direction or another? If one direction is favored over another, you can make an adjustment to how many contracts you're purchasing on one side, what strike price or what expiration month you're purchasing. What's your account size? Obviously, if you're looking to create a short strangle, you need to have an account size that ultimately allows you to put up the margin required for shorting those particular option contracts. What is your risk tolerance? Again, anytime that you create a scenario that requires you to put up margin, you're essentially, particularly again in the case of a short straddle, you have an unidentified risk exposure in that particular strategy or in that particular position. Also, whether or not you want to create a long straddle versus a long strangle, you'll recognize that one position required less capital than the other. So if you wanted to lower your risk exposure, you may look to create the straddle at the further out strike prices as opposed to creating creating the strangle at further out strike prices versus the straddle at the money. So guys, that's essentially it for this evening's presentation. Obviously, if anybody has any questions, certainly happy to answer. Just a reminder that there are a series of webinars coming up in the next couple of months, and we have here a list essentially that breaks it down all the way out until December. Some great names on here, other than of course just mine. But you got some great names throughout the next couple of months that you can take advantage of participating in. I highly encourage you to visit the fxoptions.com site. It's a fantastic site for information and education on these particular on this particular market, and it's a pretty slick site to just navigate your way through. So on that note, guys, happy to take some questions. If there are no questions, I'm just going to take a second here to review John's question here, and then we'll call it a night. Thanks, everyone.
And Jason, I just wanted to thank you for coming on there too as you're reading that comment. We had this great content here. It really kept everyone engaged. We always like to see that. And I just want to also tell everyone, make sure you check out optionsource.net. There's a lot of good tools and content on that site. And I also want to encourage everyone to sign up for the FX Options Weekly Outlook that Jason puts together for us. It's available on fxoptions.com through RSS. We also put it up on YouTube. It comes out Monday mornings before the market opens. They're really short. They're 5 to 7 minutes. Just looks what's going on in the market that week. And with that, I don't know if Jason, you wanted to talk about John's question, comment.
Yeah, sure. No. His outlook is and makes a great observation with respect to the idea of using multi-month expiration dates to participate in what would be conceivably a longer-term outlook, and he's just suggesting that without getting too in depth, that you would be more favorable to simply purchase that longer-term option contract and manage it wisely, and that's certainly a way to do that. I've had very good success with simply looking at my longer-term objectives, purchasing that longer-term option contract. But at the same time, if we recognize that a short-term option contract, if a move happens very, very quickly, then you can see a very very significant increase in the impact of implied volatility. So in fact, if we capitalize on that move quickly and make money on our short-term play as it moves against our long-term outlook, by taking advantage of that move, we are in fact lowering our cost basis for that longer term position. I know getting a little bit more advanced for some folks that might be online here, just looking for some basic ways to participate. But John, that would be ultimately my rationale behind that. One thing that I think we can agree upon, and this is something for everybody to take to heart, is that once you have an understanding, as I know many people do online here, of the dynamics of the options market, really the way that you participate in your outlook is limitless. And so looking at, everybody can look at the CDD or the EUI or the YUK, and they can have a certain particular directional bias. But I would argue that everybody is likely going to have a different way that they are going to participate, and everybody could conceivably be profitable based on their outlook as well. And so I think that at the end of the day, that's really what our consideration has to be. It's first and foremost, what are our objectives? What's our risk tolerance? How are we going to manage the trade? What are we going to do if we're wrong? And at the end of the day, that's going to keep you in business and ensure that you don't put yourself out of business when you're trading those outlooks. So we're putting forth some ideas here, and we're putting forth some strategies that you can build on. How you move forward with these is certainly going to be up to your own more or less imagination. So hopefully that covers it, John. And again, it's been a pleasure being here. And thanks everybody for joining, and of course if you want to take a look at what we have to offer, you can visit optionsource.net anytime.
All right, Jason, thank you so much again, and everyone else, this will be available on fxoptions.com later this week, and again, I encourage you to check out optionsource.net and also fxoptions.com to get the FX Options Weekly Outlook from Jason. So,
you got it.
All right, thanks, Jason, and everyone have a good evening. Enjoy this week before the holiday, and have a good Labor Day weekend.
Yeah, absolutely. And Dave, just a comment on yours. You're absolutely right. That's another way to manage it. His idea, just for people that are interested, take your directional bias, buy a long call option, trade it into a what may be a resistance level, and then maybe buy a put the hedge once you see it's possibly turning around. At the end of the day, you've just created a straddle, but it's partially through an anticipated move. It's really the same strategy, just applied a little differently, and sort of lends credibility to what I was saying with respect to how we manipulate these two different sides of the trade to participate in our own directional view. So anyways, on that note, I'm going to wrap things up here too. Thanks again, John. Have yourself a great night.
You too. Bye, everyone.
Bye, friends.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.